So to wrap up chapter 9, I'm in chapter 9. Chapter 9 talks about business income deductions and accounting methods, and they hit pretty heavy on business deductions, but there's one that they don't really talk about a whole lot. It says, this is a discussion question, and again, I'm showing you the answer because sometimes there's just such good information there. I just want you to see the whole thing. It says to provide an example of an expense associated with the production of tax-exempt income and explain what might happen if Congress repealed the prohibition against deducting expenses incurred to produce tax-exempt income. In other words, if you don't have to pay tax on the income, then you should not get to deduct the expense, which makes sense. And so it says here, and so if the IRS ever did allow that, it would be to promote investing in tax-exempt income, which they may or may not want. So you've got to read this answer. Two common examples are interest expense associated with debt used to purchase municipal bonds and life insurance premiums paid on key man insurance. If this prohibition were repealed, then taxpayers would have an incentive to borrow to invest in municipal bonds or borrow to invest in employee life insurance. The former practice would lead to higher demand for municipal bonds, less yield, and less revenue for the government. The latter practice would lead to higher demand for insurance and less revenue for the government. Both practices could lead to a perception of inequity between those taxpayers able to utilize to reduce their taxes and those who could not use the practice. And so not only does it make sense, but if you really read kind of behind the code and see what the implications are for the general public and for the government, it makes a very interesting argument. So again, just wanted you to see this. Lots of good information here that you can carry on into the next 5 chapters.